stock takes off, knowing when to limit losses and avoid holding on way too long, and having the confidence to execute. Again, all of these problems come from a lack of rule systems or a lack of confidence in them. So the whole approach of everything that we're going to cover today comes back to the key points of what Acorn provides in all levels of our education, is that we believe in keeping it simple. A little bit about me, for those of you who don't know or don't know us yet. I started trading in 2003. We started Acorn in 2007. Teaching a very, very systematic strategy that I had perfected in the years prior to that. So we've been around for quite a while now, and the whole purpose or the whole thrust behind our strategy is to keep it simple. You know, we are mostly directional traders. So what we're looking for is we're looking for very, very high probability systems and patterns within stocks and markets where we can predict a high probability move based on that pattern and have a systematic way of qualifying or quantifying if that is the right choice. Not one that could make us money, but is it the one that meets all the rules that we follow? So that's kind of our process, because we definitely believe in taking risks, calculated risks, but that's very different from being rash. So in order to consistently make money long term, we have to have a way of controlling risk and basically duplicating the same systematic trade or systematic approach across all that we do as traders. So let's come back to, let's start at the very root of a trader's day. You know, if all of us here in the room were to sit down together and I was to ask the question, right, let's look for a stock to buy tomorrow. I want everyone here to go and find the best stock to buy or short tomorrow. How would everyone here start that process off? What would you do? Would you run a scan? Would you be watching the news? Would you look at stock forums? Would you look at the newsletters you're subscribed to? Where do most people here get the idea from to start with? And while you're typing up your responses, obviously the most common things are a lot of people just have a barrage of lots of different things. News, tips from friends, TV, newsletters, brokers, things they're familiar with. G'day, Kenneth, good to see you. Yeah, these are the kinds of things that people operate with, which is fine. There's nothing inherently wrong with that, but how do we qualify those ideas? How do we take 6 different sources that all have a different reason behind them? Like some are fundamental, some are day trades, some are option trades, all different opinions, all different strategies, all different mentors. How do we take those ideas and qualify them, put them through our decision-making funnel, right? Most people don't have that decision-making funnel, which means that they're left with emotional decision-making, and which leads us to the largest problems, in the market. Okay? And that's why most people lose money. Statistically speaking, you can throw darts at a dartboard and have a 50-50 chance of being right. It's going to go up or down, right? So throw the darts away and you have a 50% chance of success. So with that, how can 95% of people statistically lose? It's because one thing that we all have in common is emotions, even educated traders. I spoke to one of my best students, of recent best students, was in one of our graduating classes last night, and we picked out an excellent trade on SGY. Anyone been following this one? It's been an absolute beauty. SGY was something we alerted as a momentum trade back here on June 20th. And that was around about 583 was our entry criteria, and we got out at 883 a couple of days later. And so that was our first trade, in and out. And then we saw that this was rallying again and had pulled back to its moving average, its 5-day moving average. So on Tuesday this week, we looked at where that moving average was rallying up to, and I'll zoom in a little bit more for you. And we said, right, this is a perfect buy if it pulls back to 1150. We want it to pull back to support, and we'll buy that retest. So 1150 to 1160, that level, that's going to be our entry point. And it did. In the morning, it went straight down to 1150, and then bang, straight up. Today, it hit our stop loss take profit criteria at 1533. That's a 40% 24-hour turnover profit. Now, when I was talking to the students, just asking who took the trade, one gentleman said, you know what, I loved the trade, but I saw it dropping down to 1150. I got scared, and I waited for it to turn around. And then once it turned around, I couldn't get in quick enough, and I finally got in at $13.30. Now, we still made a great 20% return. But how many people do that? How many people, again, they have plans. They kind of know what they want to happen, but they don't act when it does, because they're constantly waiting for that extra confirmation and leave profit on the table, get in at the wrong price, these types of things. You know, these are very, very common mistakes, even with well-educated traders. It's that level of emotion. So obviously, the first thing that we want to do in terms of starting to develop a systematic approach is we need to define what the system is that we're going to follow. And that means exactly what you want to trade. Exactly how do you determine whether the S&P 500 is bullish or bearish? Exactly how do you decide whether you're going to take longs or shorts tomorrow? Exactly what characteristics are you looking for the perfect long or the perfect short? So an example of that might be you might want to say, okay, I want a stock that's rallying up, that's contracting in range. I want to see that it's going lower and lower, closing lower and lower in the range. While that's happening, I want volume to be going down by 50% every day. Okay, I want a P to E ratio of over 300, right? I want the insiders to be selling, and I want it to be in the weakest sector in the market, and I want it to be, while it's doing while it's rallying up like that, I want it to be at the top of a right shoulder in a head and shoulder pattern. Now, would anyone not agree with me that this would be a pretty much damn perfect stock? We have a rising wedge pattern on the daily candles, volume evaporating, a ridiculous P to E ratio, all the insiders selling, and at the top, at the perfect point to the most effective pattern in the stock market for shorting in a bull market. Doesn't this sound like the perfect recipe? Well, it's close to perfect. There's actually a few other things that we add to this, but this is one of the examples of something that I scan for every day. I heard the previous presenter mention the term pocket aces. So that's exactly right. If you were a poker player, why would you ever play with anything else other than pocket aces if you had that choice? You know, and this is the beautiful thing you can do when we start to design what the perfect hand looks like in the stock market. And the best thing about the stock market is you can look at your hand before you put your money down on the table. You can see what pattern it is and whether it's something you want to trade. Okay, so let's push forward. So what is the strategy? Most people don't have one. Most people say, when I ask people what they're looking for in a stock, they say, something that's above the 20-day moving average, something where the 20 and 9-day moving average just crossed, something that's in an upward trend. Well, that could describe about 5,000 stocks. So really, that's not a recipe. That is just a vague idea, and that's not enough. Not if you're going to consistently make money with replicating the same type of trades. So how do we start to design what that recipe should be? Well, and how do we apply that to the current market conditions of what we're trading now? Well, the first thing is we want to understand that the system of trading is understanding that all market mechanisms, stocks, ETFs, currency, will never just change direction at a random point. The market is not chaotic. The market is very organized chaos. All that happens is it either speeds up or slows down, but it reverses at the exact same levels. Where the Brexit crashed from and to were very predefined levels. You can, if you want to watch the live videos, you can go on YouTube and check out our the live recordings where we made these predictions. Our predictions on the S&P 500 were that we were an expanding range downward channel, and our prediction was that we would rally up to 2110, that the Brexit would not happen and we would crash. We took profits on our puts at 2000, and then on the Tuesday, June 28th, our call on the market was that it would rally up, close at 2100, and that we'd close in the bottom half of the range and retrace from there. We'll talk about why that's very important here in a moment. But this isn't based on a crystal ball. This is based on understanding the fact that the S&P 500 was moving in a pattern. Let's have a look at what other patterns the S&P 500 is moving in now. And to do that, let's firstly start off with a weekly chart, and I want to show you the very, very starkly similar similarities to what happened in 2008. So let's go back very quickly and look at what happened in 2004 to 2008. In 2004 to 2008, the S&P 500 was clearly in an upward channel to 2007. Now, how do we know when one pattern ends and another one begins? We know that when the pattern ends. So the second that that pattern is no longer in place, we're now looking for the new pattern. And we rallied up, we retested support, and from that point on, we actually formed the next pattern. Can everyone see what that pattern was over here on the right-hand side? Can everyone see what pattern that was forming as of June 2007? It's a head and shoulders. So the chaotic drop of the market in 2007 wasn't chaotic at all. You measure the head and shoulders, that's exactly where it dropped to. We then actually formed another head and shoulders with a downward neckline. Again, highest probability strategy pattern in a bull market reversing. Measure the head and shoulders. That's where it dropped to. That's when the pattern then resets. So we know that we're then looking for the new pattern as of there. That's where the head and shoulders ends. Therefore, that's where the new pattern begins. And then we look to the right, and we've got an inverse head and shoulders. And that's where we reverse to. The entire crash of 2008 couldn't have been more technically well measured. Despite all the garbage going on in the news, it was a technical, it was all by the rules. So what do the rules tell us now? Well, again, we have the S&P 500 in a 3 to 4 year trend channel, just like before. What we can see here is if we look at the rally up, we got one touch, go back a little bit further than that. One touch, two touches, three touches on the support line, which is the classical now waiting for the break point. And you can see right there, we break down out of that upward channel, which is classic of an upward channel, and then we start forming another pattern. Because this is where that pattern ends, so this is where the next one begins. Now, can everyone see what we're forming here? Can everyone see what pattern we have forming right now? Any guesses? It's another head and shoulders. And the weekly chart, that's the most probable pattern that we can see right now. Okay. Now, let's just, for example, say that we were to take the bull argument. There is one to be made here from a technical standpoint. Again, I don't care what the news says. The news really is just there to justify what the technicals have already done. Market crashes, they say, oh, it's Brexit, and then, but only then at the end of last week, market rallied back up. The front page Yahoo Finance article was Brexit. What Brexit? It was here, now it's gone. Market's back to normal. What garbage! You know, it doesn't go away like that, but basically the news will be written to just simply give reason for the technical move. But let's play that. Let's look at the technicals. The one thing we can measure versus opinion, and let's see what the other possible arguments are. Let's go to the daily chart on the S&P 500, and let's have a look at what potentially could be building there. Let's actually flip the chart upside down. And can you see what I see there? There is an argument here that on the S&P 500, we could also have an inverse head and shoulders. But if this is the bull argument, what are we missing from this head and shoulders? What we're missing is the right shoulder. So in other words, in order for this very bullish potential pattern, which could lead us into the 2400s on the S&P 500, if this were to occur, we still need to drop to 1900 first. Remember, this chart's upside down. So the most bullish argument I see from the technicals still is a short-term bearish argument, which is a pullback of about 10%. Now let's have a look at the S&P 500 once more. All right, and we flip it back upside down, the right way up, I should say. So I have hosted this exact same topic, talking about the exact same content a few times. You know when those times were? Was July 26th last year was the first time we held this presentation called The Big One, Market Madness, The Big One. We warned people of these same facts, and we went out and bought things, puts on the SPY, puts on Polaris, puts on Lionsgate Films, these types of things. The average return on those were 300% plus on long-dated options with plenty of liquidity. We had a 10% pullback. The next time we held that same event was in December, just before Christmas. We called it our Christmas wish list Big One event. I talked about the same stuff. Again, we had a 10% pullback in the market. We are now here again, and this is the third time that we are really very vocal about this topic. And we call this the Big One 3. So as you can see, so far, but all of my assumptions or suggestions about the market is based on numbers, based on fact, based on technicals and trend lines. And if they are broken, if we break that tomorrow, I'll change my complete opinion. But the reason why these things are so important is because this is how smart money works. My opinion doesn't matter. It's irrelevant compared to the power of smart money. Think about the flash crash of 2010. The smart money was selling, the high frequency was selling, so it took the market down 1,000 points. At some magical level, they decided to start buying again. The light went from red to green, and the market went back up 1,000 points. That's the power. That's got nothing to do with me and you, and that's what the smart money can do, because it accounts for 90% of the volume in the market. So yeah, I think it's really important to understand when the smart money is going to buy and sell, and how they buy and sell is based on patterns. So So we obviously patterns are the most important thing for me to look at. Where is support and resistance? Where is my idea very valid, and when is it broken? Maybe even by a 2% move. When is that idea disproven? So I've talked about the pattern. We also want to talk about a technical way we can read smart money as well. So so smart money, yes, also a cup and handle. Yeah, so the other thing we look at with smart money is we want to look at something called money flow. And money flow is very important because, you know, a lot of people I see have lots of indicators on their charts. They have things like stochastics, directional movement, on balance volume. You know what all those things are just doing? They're just telling you whether there's a real uptrend or a real downtrend. Stochastics measure where the stock's closing in its range. On balance volume tells you if volume is accumulating with the move or dissipating. Directional movement tells you whether there are new highs or new lows. Okay, fine. You can see that in the chart anyway. But I mean, but really, the reason why those indicators are important is because they're telling the trader whether there are the personality traits of a real uptrend or downtrend. Because a real uptrend will close higher and higher in its range. It will add to its volume as it goes up instead of take away. It'll make new highs and higher lows. That's the characteristics, all three things combined, of a real uptrend. And what money flow does is it looks at all of that. And one of the things that you may notice about this rally in the S&P 500 is that money flow has been going the opposite way. So money flow is pulling out of the market, or smart money is selling instead of buying. Let's go one step further. So again, this is one of the slides from the last time I did the big one, back in December. All right? Remember the rally? Christmas rally, everybody. Go out and buy yourself a stocking full of stocks. Well, just remember that the stock market is far from honest. I'll use that way of phrasing it. The big boys out there and the hedge fund managers and things, they're not there to help you, or me for that matter. They're there to make money. The stock market is the most capitalist format of money there is in the world. It represents money, right? Doesn't it? So when you start to hear, Goldman Sachs saying where the S&P 500 will go, while they start to pay billions of dollars in fines for things that the SEC are fining them for not doing proper dealings with their clients, things like that, as every other fund was. Big money, if the big money, the smart money, thinks the market's about to crash to another 10% down to 1900, or worse still, down to some of the real lows of 1450, 1500, if the bear side of the head and shoulders takes place, they're not going to tell you. You're not going to read it in the newspaper. I referenced the Big Short at the start of this presentation. Just remember that the people that make the most money being on top of this market aren't the people that react to the news after it happens. It wasn't the people that started shorting after Lehman Brothers. The real big money happens when you are able to get ahead of the market by seeing what the smart money is doing and noticing the trends. So just like in the Big Short, where what was it, Ashton Kutcher or something? I can't remember, but he was called nuts. He was crazy. How dare you short the U.S. housing market? Are you nuts? Standard & Poor's thinks you're nuts. The Fed chairman, Bernanke, thinks you're nuts, but he was right. The smart money isn't there to tell you the truth. I think we just found out that the oil numbers were phony, and oil is crashing today as a result. Don't believe anything. Look at what the smart money is doing. That's the only real way to know for sure, or at least have high probability. So what is going on, of course? We have massive threats to the market right now. These are the same threats since 2010. They've just been getting worse and worse. Asian economies, Greece, Europe, bankruptcies. The first domino to fall will be bankruptcies. I mean, Puerto Rico can't pay its debt. That's the first time that's happened in a very long time. They're defaulting. As soon as we get one big domino to fall, the rest start to follow. And that's that. And by then, it's really too late. Now you're chasing the market. But highly leveraged companies would be in trouble. Credit tightening, companies find it difficult to borrow. You start to see a lot of defensive mechanisms and of hiring policies, contraction, not spending on infrastructure, just going into survival mode. This is already seeing a mass liquidation in the stock market. Bank of America Merrill Lynch in March produced a report that said that they had seen the longest and largest mass exodus of equities for a 5-week streak. It's the longest and largest since 2008. Are people selling? Remember what was happening in March? The market was rallying, but people were getting the hell out. Why? Because if the house of cards falls, the implications are huge. Because the more and more we've propped this market up on speculation and derivatives, we've created a $600 trillion bubble. That's a bubble that's bigger than all of the real estate in all of the world put together. And if you want to read about that, there's a great book called Juggling Dynamite by Danielle, it's a female, Danielle Parks. Very, very good book. But she talks about this, that we are standing on the top of a very fragile framework, and if a bottom was to fall out, there is a vacuum, and there won't be any buyers there, and that's where things just fall on their own weight. You've already seen that high price to earnings ratio companies are getting attacked. Fund managers are getting out of these risk-on assets and going and flooding to things like utilities, telecommunications. Look at how strong those sectors have been. The smart money isn't buying high risk right now, if not just completely exiting the market. Again, as I mentioned, companies are in survival mode. So as we've seen already, this has resulted in massive volatility that we've seen in the market, and the question now is, what's next? Well, let me throw a few more statistics at you, things that we can measure. Firstly, the warning signs we're getting now are the same, if not worse, than 2008. So could I be wrong? Absolutely. Could the technicals change? Could something dramatic change tomorrow that would reverse my opinion, and I would exit my puts and start buying calls? Absolutely. That, as a trader, we need to be able to have that agility to completely change our opinion if the situation changes. But this situation's been building for a while, and although I could be wrong, it would seem insane to ignore all of the red flags, seeing as these exact same variables technically would have predicted the crash in December, in July, this is last year, in 2010 when the European Union crisis happened, and in 2008. We've been on the top of every major correction in the market, which is something I'm very proud of. Not many people can say that, and it was using what I'm showing you now. So let's go further. Let's look at what the smart money is doing on a more granular level. Let's look at what if they're actually buying or selling the market themselves. This is a report on the insider selling versus buying activity in the month of March. Quick clue, the red is selling. Massive difference. Let's have a look at April. Just remember that March and April and May, the market was rallying hard. It was a monster rally. But did insiders use that as an opportunity to buy more of their own stock, anticipating a wonderful bull market to continue? No. The smart money sold. Not just small amounts, but it looks like roughly, 50 to 1 or more ratio? May, financials, healthcare, services. June. This is basically a summary of the last 90 days. This is what we call mass exodus of smart money. Now, that doesn't mean necessarily that the market is absolutely going to crumble. I think we should at least correct, which is a 10% drop in the markets. But it doesn't necessarily say the sky is falling, but it certainly doesn't seem to think that we're about to boom off for another 20% rally, because if that was the case, would you sell? Would you sell this much? No. And of course, what we can see on top of all this is it's not just the background of where the fundamentals are going from an insider standpoint, the patterns of the market are telling us this too. And we're dealing with one of the most probable patterns there is. So rather than, the whole purpose kind of what we're looking at is we're looking at a potential big one crash. And so rather than making decisions by reading through tons of information, scouring hundreds of stocks every day, why not start? We should start. If we build our trading mentality around rule systems, like what I'm showing you here, things that we can are black and white. Is this happening? Yes or no? We can become a lot more powerful. Okay. All right. So let's. So last thing I'll show you is another one. I told you there's a very, very, really important reason about what happened here on Friday, July 1st. Something you may not know about the S&P 500 is something called open range. Now, on the first trading day of the month, a range is set. Okay, the first trading day of the month, a range is set. Now, whether the market, the S&P 500, closes above or below that range the next day or the day after, wherever the next day is that it closes, if it closes above or below that range, that will tell you the bias of the S&P to an 80% degree of probability. I've backtested this over 3-4 years. Go and do it yourself. Go back and have a look at on the first trading day of the month. If it breaks higher, the market goes higher. If it breaks lower, the market goes lower. 80% of the time, roughly. That is a very powerful probability to have in your favor. And that will stay the case until options expiration Friday, the third Friday. So it's a very powerful indicator, which is valid then for about 2-3 weeks, which is where you make all your money. So that just after the first trading day of the month and just after options expiration, we get a very strong bias of which way the market's going to go. Now look what happened. What was just so beautiful about this is that we rallied straight into resistance and created open range at that level. We then broke more than 3 points, in fact 9 points lower than that. And as you can see, we're now respecting that open range beautifully. Market rally today hit that trend line. I haven't even looked at this yet. Hit that trend line perfectly, confirming our suspicion, or the probability of our suspicion, that we're in a downward channel. And as you can see, respecting the open range and dropping. Very, very important stuff. If you had a system, a strategy that worked 80% of the time, would you ignore it? No, you wouldn't. This open range is go back. You can go back over the three years of history if you want yourself and look at the numbers. There are certain qualifying factors we use, and which makes it higher probability. But in the general sense, this is the theme of this. And I would never ignore that. Now, I'll still take longs. I still took SGY. I got into that trade. I'm still looking at call options on some pharmaceuticals that may blow up into the upward direction, things of that nature. But my core positions are all building puts in stocks that are really just set to plummet. Stocks where there's a 20, 30, 40% decline. High probability of that, where we can look at buying options and pick up anywhere from 300, 400, 500% if that does in fact occur. So this is why this is the big one. Those aren't the type of returns we are normally looking for. They're great when they happen, but I mean, typically our strategies are built around finding an 8 to 12% move in a stock. At the moment, we're looking for setups where there's a 20, 30, 40, 50% move that could be really quite realistically materialized if this type of drop in the market occurs. And I say that because we've done this twice already, and we have seen those types of drops in the stocks we selected. So how do you find those? How do you find those opportunities? You have to have a recipe, and as I said, we're very directional. My specialty, if you ask me how to trade an iron condor, I wouldn't have a clue. I mean, probably up until 2 years ago, I thought that was a kind of bird. So look, we're not fancy about options. We don't get into futures. We don't get into any of those things. What we're really good at is looking at a chart and saying, right, that stock has extremely high probability of going up or down 10, 20, whatever percent it is. Where is support? Where is resistance? How do we manage that trade correctly with rules, not based on guessing or putting the stop loss where you want it to be, but where is the chart telling us that needs to be to follow the rules? And then just simply using options to leverage the hell out of it if it's a big move potential. That's what we do. And we have about 4 strategies, 4 very highly probable patterns that we scan for every day. There's 100 patterns in the market, right? Just for example, double tops. You can have Adam and Adam double tops, Adam and Eve double tops, Eve and Eve double tops, Eve and Adam double tops. The only ones you want to trade are those. This ranks about a 13 out of 100 in terms of probability and profitability, and Eve and Eve ranks 49. Again, terrible cards. And there's your races. Don't ever trade an Eve and Eve. You see what I'm saying? So what we do is we scan the market every day looking for this perfect storm of stocks that are set up for this very large potential drop. And once you have that recipe, you then stick to it. Once it's consistently making you money, you then don't need to go to the noise of what you hear on TV and things like that. You simply are looking for stocks that meet your strategy and trying to figure out what strategy works for the ideas you find. So we're coming to the end of our time here. I think we're almost up. We've got 4 minutes left. So what are we offering? So this is the highest value offer I can possibly give you. This is where you get right to the roots of what to trade tomorrow. Because right now we're at a very sensitive time in the market. We're just breaking down from open range now. So we're anticipating that the beginning of this downward descent towards the 1900 level on the S&P 500 is today. So we changed our offer entirely this morning, seeing what was going on, to get you the most direct way to access these trades and profit from them. And that is to teach you the scan, so that you can then implement that in your own system. You can employ our smart money indicators, start working with them immediately, and you could be running the scan, an hour from now. And starting, not only do we give you the scan that's finding these stocks, but we also then show you the rules we use once we found the stocks of how to decide which one's going to be the best to trade. And it's as I said at the beginning of the talk today, it's about keeping it simple. It's about being able to go from scan to decision within a 10 to 20 minute period, knowing exactly what you're going to trade the next day and where you're going to trade it at. That's exactly what this 4-module workshop will do. Is it's going to get you right into the heart of scanning for these high probability setups. Again, as a bonus offer, what we want to do to fast track your ability to get up to speed with where we're at in terms of the opportunities in the market, we're also going to give you our perfect storms. So this is a list of entries, exits, stop criteria, and options for trades that we have scrutinized all the way from the top down. There has literally been hundreds of hours of research done through all of our scans to find the absolute top opportunities that are likely to have a 20–30% drop. And this is something you'll get it's basically will be an on-demand video that you'll get instant access to that will summarize all of our positions and show you exactly what we're looking for in terms of setups. Not only will you get that, get the access to that, but you can also, in fact, go into our members portal on our website, and you'll be able to go in and actually, excuse me there, you'll be able to go in and view all of those ones that we're kind of catching up with. Okay. So yeah, when you go onto the website here, we've got 1 minute left here, I'm being told, so we'll speed things up. So just as you go onto our web portal, you can go into trading alerts, and you'll actually see our alerts right there. We've got July up, and not only will you see the alerts, the entry price, the take profit price, the strategy, conviction, all of those things. You can then also actually bring up the chart and actually see what our analysis was when we alerted it, and and then it'll actually load and show you the forward moving action, so you can go back over our past alerts and learn from that. So we're out of time here. One thing I will include for you, though, for everyone purchasing today, is we do have a Tuesday, Thursday live class reviewing all of our active trades. So we have one tonight. You'll get an invitation to that. And one actual bonus that we're going to be including as well, given, again, the importance of the market conditions now, is access to our open range strategy. There is an hour-long lesson teaching you open range, as I just talked to you about before. There's obviously more to it than a 5-minute soundbite. If you learn to trade this properly, you've got 80% of market direction probability now on your side. No matter if you ever trade one of our scans ever, and you just stick with what you're already doing, this alone should add a huge weight to what you're doing. So that's all we have time for, folks. Thank you so much for everybody. It's too much to cram into a small session, but I wanted you to get it all. If you do have any questions, if I've missed anything, I'll just have to fast forward here. Here is the email address, and here is our phone number, and I'll leave that with you. So I see a couple of questions for me. Please shoot that to me on your email, and I'll get back to you within the next hour. But otherwise, look forward to hopefully seeing a lot of you tonight in our live trading room, and have a great day. Thank you so much.